Hi guys, welcome back to my channel. Kelvin here. Market crash is the second scariest crash in my life, with the scariest crash being League of Legends crashing while I'm playing rank. When we are investing, we are always scared that the next market crash is coming, and the Wall Street pros aren't helping either. They always like to scare us that the next market crash is right around the corner, like the stock market could crash in the next 3 months, or the stock market could tumble even if the pandemic is over next year. And they really like to exaggerate it, saying stuff like world's richest have lost over 1 trillion in stock market crash, or world's richest lost 444 billion after hellish week. Every time I see these kind of articles, I'll be like, shut up lah! Because the thing is, what all these articles are doing are nothing more than just spreading fear every other day, like how Sotheby's spread his thoughts. In reality, a stock market crash is not that scary at all. In fact, what if I told you that the stock market crash is good for you? You'll be like, huh? What you say? Yes, you heard that right. Not only the stock market crash is good, in fact, you should look forward to them. So, in this video, I'll explain to you why I like the stock market crash and what's the best way to invest, knowing that the next market crash will come sooner or later. So let's not waste any time and let's jump right in. I know there's a very shock feeling seeing your stocks going up 10%, 20%. When your stocks are green, it makes you feel that you are actually good at investing, like you are a god of investing. The main reason why people hate market crash is because their stock portfolio will become red, like it's dressed up for Chinese New Year. That and they lose money on paper. It makes you feel shame, like shame. Trust me, I know that feeling of failure seeing that your stocks are in the red, like you did something wrong. How I know? That's because almost 75% of my portfolio is in Tesla, which drops 10% every other day. With my portfolio currently above 150k in value and concentrated in Tesla, I am easily losing 5k, 10k every other day when it drops. So every time the market goes down, I'm already used to seeing my portfolio becoming super red. And every time I see people complaining that the stock has dropped by 5% and they lost $100 in paper profits, I'll be like, first time? Which brings me to the reason why I like stock market crash. When the market drops a lot, it only means one thing. We are all going to die. Just kidding, it means that another Black Friday sale is here without all that weird Shopee singing. Let me ask you this, you like all those Shopee sales, right? The reason is because you can buy stuff that you like at 10%, 20% discount. But if you see the stuff that you like goes up in price, you'll be like, aiya, so expensive sia. That's the same reason for me. I look forward to my stocks going down because now I can buy stocks at a huge discount. The more it can go down, the more I get to buy. To visualize this, let's look at Apple. Yeah, sure, once in a while, they will come out with super overpriced stuff. But we can all agree that Apple is a successful fruit company, right? If we only look at the short term, we don't know which way the stock will go. We only know it will go right. But if we zoom all the way out, everything becomes very clear. Good stocks will only go up because stonks. And of course, also right. As Benjamin Graham once said, in the short run, the market is a voting machine. But in the long run, the market is a weighing machine. So would you rather buy stocks here when it's all-time high or here when it's much cheaper? But we can't normally get this kind of cheap prices unless the stock market crash comes along. Which brings me to my next point. A market crash will cool down the market. The price of the stock is determined by supply and demand. The more people who want to buy a stock, the higher the stock price will go. And the higher the stock price goes, the more people will want to buy that stock. This creates an endless loop that feeds back into itself, eventually creating a bubble. This was exactly what caused the famous tulip mania in the 1600s. People in Holland suddenly like tulips, and by like, I mean super like. They keep buying and trading tulips, causing the price of tulips to become 10 times the annual income of a skilled artisan. All of a sudden, in 1637, everyone suddenly realized that something was wrong and be like, siao ah, why this flower so expensive ah? Then the price of tulips started to crash like nobody business. Time and time again, we will see this kind of crash happening, like the Wall Street crash of 1929 and the 1990s dot-com bubble. The more exponential the market goes, the harder it will fall. When it goes this high, it's likely to crash back down. But surprisingly, the higher the stock market goes, the more people who want to dump their money in. Meanwhile, I'm like, walao everything's so expensive. Like the fish at my Cai Fan store, the only thing that can calm the market down is a market crash, which will cool it down back to normal levels. And that's when it's the best time to invest. Think about it, is it easier to get rich when you are buying at all-time high or when you are buying when everything is crashing left and right? Definitely when the market is crashing right, that's because we know that good stocks will always recover. If we have bought in and they recovered, we will what big. We can see this happening all the time, like Business Insider reporting that billionaires in America got 44% richer during the pandemic. There's a saying, riches are made in recession. And that's why it's good to have a market crash coming along every once in a while so that it can cool the market down. Then you may say, hey, say until so easy, when the market crashed 30%, 40%, how you diamond hands ah? That's a good question. How do I actually manage my feelings when investing? It may not seem like it, but even though I'm skinny, I actually have feelings. Get it? Feeling? Just aside, the reason I have diamond hands is because I am confident in the stocks in my portfolio. Stocks which I know have real fundamental value. That's why I only buy stocks which I'm confident in, and not some random meme stocks which people say can 2x, 3x tomorrow. GameStop. When we look at the stock, we only see the counter name, price and chart. But behind all this is a real company with real people and real products. That's why when you invest in a company, you need to do more than just ask some random YouTuber, can invest ah? Is it too late to buy ah? If you just take the time to study the stock, you have the confidence to hold the stock, even if the stock drops by 50%. Warren Buffett has once said, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Yes, you can speculate on stocks or gamble your money in the world's biggest casino. It's not wrong. The one thing I notice is, when people invest in stocks, they only think about the upside. Like, they think that GameStop can go to $500, $1,000 or $10,000. But people rarely think about the downside, that there's actually a higher chance that GameStop can actually crash back to $50. So how do I manage my feelings in investing? I find it super helpful to have an end goal. Ask yourself, why are you investing your money in the stock market? Is it for a short-term goal, like growing your money so that you can buy a car or maybe a house? Or for a trip overseas, when this whole pandemic is over of course? Or is it to grow your money so that you can achieve financial independence? This goal needs to be quantifiable. You need to know exactly how much you need and by when do you need it. It's like us going out of our house to go somewhere. Before we even step out of the house, we need to know where we are going. Maybe it's going to office to work or going to the mall to pak tor with your bee. If we don't even know where we want to go, we are just going to agak-agak and run around like a headless chicken. More often than not, we will get lost and GG. So we need to have an end goal in mind. Then we can start planning how to get there. Maybe your goal is to have enough to use during retirement and you need jibaban. If you are 20 years old now, you still have 40 years to reach that goal. Then maybe you can invest in dividend stocks to let your money compound safely at 4% return a year, or invest in growth stocks to let it grow more. Personally, my goal is to achieve financial independence by 40 years old. I have 7 years left to achieve it, and the amount I need is $1 million. That means I can't anyhow YOLO my money into meme stocks, because if anything goes wrong, it will set me back by a lot. So I will need to plan my path carefully. After knowing my end goal, I will decide what I can only invest in. This can keep changing as you learn. For example, I started out with dividend investing. Then, when I realized that it is too slow, I changed to investing in index funds. Then, around 2 years ago, I decided to change to growth stocks so that I can grow my money much faster. And it just can't be any random stocks, right? It needs to be fundamentally good, maybe like Facebook, Tesla, Google or Amazon. If you take the time to study the company, most of the time you will roughly know whether it's a good company or not. Next, I need to have a buying strategy. Do I try to dollar cost average or lump sum invest? I know many investors, especially new investors, like to time the market. They be like, if you buy low sell high, you will fat da cai. Well, yes, but no. It sounds good in theory, but you will never be able to time the market perfectly. There's a website where you can try this out. I'll link it down below. You can only buy once and sell once. Try it out and let me know how well you did. Studies have shown that lump sum investing gives the highest return, while dollar cost average gives the most consistent return overall. So I decided to just dollar cost average. It achieves several things. First, if I don't time the market, I will never time it wrongly. Second, it allows me to take advantage of market crashes. If the stock drops by a lot, I'll be like, yes, it's shopping time. Third, dollar cost average allows me to invest my money consistently. From 2010 all the way to 2020, there were tons of so-called pro analysts shouting that the market is crashing soon. So much so that someone came out with a chart of shame showing how much the market went up every time someone warns that the market is crashing. If you have listened to these people and be like, let me wait for the next market crash to invest, you'll be missing out on the greatest bull run so far. potentially missing out on the chance to 3x your money. Or if you have waited for another crash after March 2020, you will have lost the chance to 2x your money. Who knows when the next market crash is coming? It could be tomorrow, next week, or 10 years time. You can't control it, so don't even bother trying to time it. Use the most proven method to invest, which is dollar cost average, and you'll be fine. After buying, you will need to have a plan. When should you sell this stock? If the stock goes up 5%, should you sell? If the stock goes down 10%, should you have diamond hand? I always get questions like, your Tesla stock went up, when are you planning to sell it? And my answer is always, I will only sell when I need the money or if I found a better investing opportunity. In an interview, Chamath, the billionaire, once complained,
Scott, I don't understand why people are so focused on selling things that work. Let's just, I'll make up a number. Let's just say I owned $1 billion of Tesla stock. If I sold it, now I have $1 billion problem. What do I do with that money? What about if it was 100 million? What about if it was just 10,000? 10 billion? It doesn't matter what the number is. The point is that when things are working, you're paid to stay with people that know what they're doing.
And I agree. Let's say if you found a stock that's good, like Tesla, if you decide to sell the stock, you will need to find something else that can give you a much better return. Otherwise, you and your money will cry when the stock that you just sold went to the moon. On the other hand, people like to hold stocks that are super bad. A good example is First REIT. Even when it crashed from $1 all the way to 20 cents, they will continue to hold it. They'll be like, I am holding because I hope it will recover in the future. In my opinion, hope is not a very good plan. You might as well say you don't have any plan. Instead, if you are holding a bad stock, a better way is just to sell away the stock, then move your money elsewhere. There's a much higher chance to grow your money back. So those are my plans when investing. Know your goal, pick only good stocks, have a buying strategy and a selling strategy. With these plans, you'll be fully prepared when the market crash comes. No, not only that, you'll be super happy when the market crash comes. And that's all for today. Let me know what do you think. Do you like stock market crash? Like, share and subscribe as I'll be posting new videos every Monday and sometimes Friday.